What is depreciation recapture for capital gains tax? Have you ever wondered how selling an asset you have depreciated affects your taxes? Let's break down the concept of depreciation recapture in the context of capital gains tax. Depreciation recapture is a tax rule that comes into play when you sell a business or investment asset that you have previously depreciated. This often includes items like rental properties or equipment. When you sell such an asset for more than its depreciated value, the Internal Revenue Service requires you to recapture the tax benefits you received from those depreciation deductions. This means part of your gain is taxed as ordinary income instead of the typically lower capital gains tax rate. To put it simply, depreciation allows you to deduct a portion of an asset's value each year from your taxable income. For instance, if you own a rental property, you can reduce your taxable income by claiming depreciation. However, when you sell that property, the Internal Revenue Service looks at how much depreciation you claimed. They tax that amount of your gain at ordinary income tax rates, which can be as high as 25%, rather than the capital gains rate. Any gain beyond the depreciation recapture amount is taxed as a capital gain. This rule is designed to prevent taxpayers from benefiting twice. First, you reduce your taxable income through depreciation deductions, and then you would pay a lower capital gains tax on the full sale profit. Different types of assets have different rules for depreciation recapture. For example, Section 1245 property, which includes personal property like equipment, recaptures all depreciation as ordinary income. On the other hand, Section 1250 property, which includes real estate, typically recaptures only the excess of accelerated depreciation over straight-line depreciation at ordinary income rates. The remainder is taxed as capital gains. For Asian American investors and business owners, understanding depreciation recapture is essential when planning to sell investment properties or business assets. If not anticipated, it can significantly increase your tax bill. There are strategies to manage or defer depreciation recapture tax. One option is to use a Section 1301 exchange, which allows you to defer taxes by reinvesting the proceeds into a similar property. Another strategy is timing the sale to occur in a year when your income tax bracket is lower. Additionally, investing in qualified opportunity funds can provide tax incentives. Knowing how depreciation recapture works helps you optimize your tax planning and avoid unexpected tax liabilities when selling depreciated assets. Consulting with a tax professional who understands your specific situation is always a wise choice to navigate these rules effectively.